Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hey everybody, welcome to Vantage Point with True North Wealth Partners. Today is Tuesday, August 22nd. Hope all is well. Episode number 37. So with us today, we're going to have a guest, one of our specialists in education, career planning, self-assessments, guides, Beth Probst from At the Core. So she'll be here later on in the segment. Also, please be sure you hit the subscribe button, check that, so that therefore every time these are released on a monthly basis, you will then receive those automatically. Also, just a little plug on our website too. We'll be pushing this episode out on Friday. We'll be having a tab, educational piece tab, just solely on education. We have new enhanced relationships with our partners. College Aid Pro as CAP, so CAP Plus is who we'll be using, and also with Beth Probst. Again, she's been on our shows before, and I've and Andy have used her personally for over the past, 5 to 8 years. So At the Core will be on there, a segment, also with CAP, College Aid Pro as well. So for folks who want to learn more about how we can help you all and benefiting through the college, navigating what to do for that. So that's a nice new service we're offering for free for our clients and those who can benefit from that. So with that said, we'll get into just a few of the market aspects. So if you recall, last month we mentioned basically how things were eerie, calm on the volatility specter. They've spiked up somewhat, nothing major, but from the 13 to 17, 18-ish range. So at least it has come up some. That's because the markets of the S&P has fallen back basically about roughly 4.8%. So it's not officially a 5% pullback. So on our chart, you will still see only one marking of a 5% pullback, but we were close to that. So almost a 5% pullbacks thus far. A lot of volatility the past few weeks. It's normal. It is the season. August, September are typically the worst months of the cycle in the markets as well. Things are, again, economy, parts are still good, parts are slowing. So we still have that ebb and flow, rolling recession parts of the economy all throughout. So, we've all been on calls, research calls, client meetings, just hearing feedback from folks. So, still good. And or the annuity route, the fixed annuities are still good. Long-term care options, we're still doing many of those. And then the CDs with rates still elevated. The Fed will probably raise rates one more time at the September meeting. Speaking about the Fed, so Jerome Powell has the Jackson Hole meeting here this Friday. So that's an annual meeting. They get together, they talk about things. So we'll see. I don't know if he's going to move the markets much, but I think the economy and the markets are coming around that, hey, he means what he says. He's going to be raising rates at least in one more 25 basis points at least, and he's going to keep it elevated and lock it down, meaning hold it for longer. The expectation now, Goldman Sachs came out that, okay, they don't see the Fed cutting rates till the second quarter now of 2024. So that's a long time between now and then to keep rates elevated, and all for the effect of cooling down, i.e. the economy, employment, and taming inflation. The Fed's, again, ultimate goal is to get the PCE, the inflation, the inflation down to 2% is the idea. So they're still chugging away, making progress. parts of the economy on the inflation has eased subsidedly a lot. Other parts are still coming back up. So energy has one. So, we had like a 3% print and with 3.1. So it might be just curling up a little bit. So again, using a lot of our research folks from Hedgeye and others, we do anticipate CPI inflation metrics to still be elevated in the 3 range for the next couple quarters. So that's where we're at. Earnings were good for the second quarter, surprisingly good, I should say. With that said, though, one of our other trusted partners is First Trust. And basically with all the metrics and where the 10-year is right now, they put it into the models. The fair value estimate they projected still is at 3,900 for the S&P, as they're comfortable keeping their target at 3,900 by year end. So we're basically at 4,390 on the S&P as of today, 4,390, and they're saying roughly 3,900. So you see the trajectory. So choppiness slightly down. So the high watermark for this year was on July 31st for the indexes and clients' accounts portfolios. So July 31st, 2023 was the high watermark. And then since then, the markets have pulled things down. So choppiness is what we anticipate for the next few quarters. So going back to Hedgeye, one of our trusted partners, again, quads 1, 2, 3, 4, spring, summer, fall, winter. So we're in a quad 4 right now. Third quarter, quad 4 for the fourth quarter. And then they anticipate a quad 3 for the first quarter of 2024 and a quad 3 for the second quarter of 2024. So basically, easy money is the top 2 quads, 1 and 2. It gets a little bit harder in 3, and it's not good in 4. So what I'm saying is, even though the markets have had positive run up, et cetera, it's going to be choppy and tight, a lot of ebb and flow over these next few quarters. So interesting how the back halves of the year, we, starting out this year, we said, hey, the first half of the year would be easier, back half, harder first half, back half would be a little bit easier. It's really vice versa. So first half of this year was easier market-wise. The back half we anticipate to be a little choppier and harder. So it's been very interesting, challenging year to say the least. Folks are still all over the place as far as earnings, projections, things of that nature. I still have the frequency tracker, things that we follow again from First Trust. This is a nice summary snapshot. So jobless claims, it's still holding in there. The staffing level, remember, I saw that little dip. Well, the dip has now come back up some. So that was just a temporary, must have been a 1 month, summer blip. Retail sales are still sort of lagging. Nothing great there. In regards to the steel production, just sort of hovering in there, but still lagging other prior years from COVID. Box office receipts have dropped down. Rail car has sort of leveled off, still trailing other years. Hotel occupancy was elevated, but now starting to curl back a little bit. TSA has peaked and now coming down. And commercial flights is surprisingly all-time high. So people are still flying abroad. So just wanted to just touch base on that. Again, a lot of sectors within the markets year to date. Things are still chugging along. It's been crazy in the bond market. So the bond markets and the treasuries really have moved up in the past 2 weeks. So you have the 10-year, 4.36 in that range. So the inverted of the yield curve is still there as well. So again, it's just a lot of choppiness. Slight changes. I know all the advisors. We have Andy, Eric, Jim, Russ, myself, monitoring things constantly on plenty of calls as far as when to get into more bonds, less bonds, the right types of bonds. So it's interesting on the yield curve, the front end, it's been inverted. So that means the 3-month, the 2-year, et cetera, are getting more yield than the back end, the 5, 10, 15, 20 year. So as the Fed gets closer to peaking terminal rate, peak at one more a quarter basis point, then you can go longer in duration as once they feel that, get close to that. So we're almost there. So again, we're still in a defensive tilt. I know there's, for every one article that says, hey, the worst is behind us, we see 5 articles and calls that say, hey, no, it's not. It's going to be strapped in for some choppiness for the next few quarters. So more ebb and flow back and forth. One other little point I want to mention is the 0 days to options, zero DTE. Basically, it's the 0 days to option expiration. That is now controlling trade volume. So I have tracked trade volume since back in my T. Rowe Price days, and it's pretty much flat. I'm seeing 3 billion trades to 3.7. And that's even on quadruple witching days or just options expiration days on Fridays. It's blah. So there's a big shift with Tier 1 Alpha that we use within Hedgeye. A lot of charts. It's technical. I won't bore you with it now, but the summary is this. The takeaway is within the past 2 weeks, the S&P 500, half of the trading volume on the S&P 500 is 0 date to expiration, so options expirations. They play it for the day trades. So the market makers may load up on the first half of the day. That's why you see these big intraday swings. You can see it go up and then they sell off, or vice versa. If the markets are down 300 points in the Dow and then it comes back up, it could be flat or positive for the day. So these market makers are manipulating and adjusting their books on a daily basis, and they're not going long as much now, meaning using the VIX Volatility Index going 30 days out. The game has changed. You've been hearing me say this all year long. It has changed dramatically. So it's just interesting how fast these markets move. And when the dam breaks, it's going to be an interesting, real volatile time, because these market makers have to adjust their options, their booklets, either going long or short and covering and repositioning. So we anticipate more days like we had these past 2 weeks. We anticipate more of that over these next few quarters is the upshot. So you'll be hearing me. I'll probably do a segment just on that alone, because I've been seeing all these charts the past few months from our research teams about that. So just something I wanted to throw out. You hear me talking more about that and less of the VIX per se. I'll still talk about the VIX, but it's not as important as it once was for the past 40, 50 years. With that, basically, let's turn it over to our segment with Beth Probst at the Core. All right, everybody, welcome to this segment with one of our trusted partners that we utilize for key information for when it comes to schooling, prepping, middle school, high school, college prep, all that good stuff. Welcome, Beth Probst from At the Core.
Eric, thanks for having me again. I'll throw career in there too, because I'm always chuckling. We work so hard to get our kids to and through high school and to and through college, and then zip on the other side. Guess what they start? Their work, right? And we want them to do work they love, and that lets them be independent and confident and play to their strengths. So
you've done a great job. So Beth and her crew, her team, trusted partners with us for many years now, and they're going on 12 years. And again, you'll see on our website a page that will have both information for At the Core plus CAP, which is College Aid Pro. So again, we're rolling that out together. Two trusted partners that we utilize for our clients and folks who can tap into their strengths and helping all the kiddos get through.
That is so awesome. That's going to help tremendously.
We're excited.
Your clients need resources that they can trust and that have that depth and richness to really support them as they're moving through those financial side, and then the high school, the college, the career side.
Yeah,
so
totally
we're proud to do that. Yeah. So we're in back to school mode.
Back to school mode.
You just sent 2 kids back to school. Is that right?
Thursday they go.
Thursday. Oh, Thursday they go. They haven't started yet.
Yeah, it's
Got
okay.
It.
But I heard your 2 kiddos. One's out working, the other one's getting
underway. That's right. So we are back to school time. Yes, you too. And new backpacks at your house?
Oh, yeah. You should see it. My youngest is all excited. Look, Daddy. She's all...
I always loved a new backpack.
It's good.
New clothes, new backpack.
Lunch, her little lunch thing. So,
Perfect.
It's cool.
But perfect. Good. So as I was coming over here today to meet with you, I was thinking about some things that, back to school conjures up all kinds of things. And as parents, we all know it's a time of, especially if you switch schools. How do I, pay for lunch, and how do I pick up my kiddo if they, have a dentist appointment, and who's the tough teacher that they have, and what do they need to think about? I just wanted to share just a couple of back to
Please.
school things,
Yeah,
super quick.
Yeah.
Just back at a maybe more of a 10,000 foot level. And as parents and students enter this next school year, I want to remind them that academics matter, that experiences matter, and that evaluating those experiences matter. So let me just take a little minute on each one. So academics matter. Well, I mean, duh, right? So in the end, if your high school experience, you have this GPA and you have this set of classes that you took, and then you're probably going to have an ACT or an SAT score that's also tied to your academics, what you learned and how you can show that through those tests. Those academics do matter because they will lead to opening or closing certain doors at the end of high school. So it is important to always remember that academics matter. So every day, that's chipping away, doing the homework, all those things.
Are you listening, Ella?
I know Ella's listening. So then experiences, though, they matter too. So as our kiddos are journeying through their middle school and high school years, we love part-time jobs and sports and clubs and also creative things like informational interviews and job shadowing and summer camps and programs that let them get close to something that they might already have an interest in. Those experiences, when aligned with or connected to their academics, make 1 + 1 = 3. I know that's academically incorrect, but it really enriches. It enriches their high school experience. And then the third thing, evaluating those experiences. We are big believers in a student taking the time, and they don't do this naturally. So as parents, we do need to coach them to do this and kind of teach them to do this, to really think about, all right, I just finished that huge history project. What did I learn about myself in that process? What did I struggle with? What did I really enjoy? What would I want? What would I do differently if I did it in the future? Same thing with like a camp. I remember my oldest went to a camp called Ohio Business Week. Great camp. Still happens. It's like an immersion kind of week of running a business. At the end of that, on the way home, I remember gently peppering him with those questions to get him to think about what did you love? What did you hate? What part of it was awful? That evaluating those experiences lets a kiddo start to make connections between what they've learned and the little nuggets that are going to help them make great choices about college and career in the future. So those three are my back to school tips. So academics matter, experiences matter, and then evaluating those experiences.
That last part's key.
It is.
You're right.
But they don't do that. So an occasional kiddo will naturally do that, but most are like, okay, done with that experience, and I'm moving on to the next experience. We really want to take a minute, breathe, and think about what you just learned.
Excellent. No, that's good. And then with certain schools, like we've done some job shadowing here, even with our with Dublin school systems, and we had kiddos come through here and educate that. So we try to help as much as we can, offering.
That's huge. And thank you for doing that. That's huge.
So no, we're big in
because someone may come and say, I think I'm interested in the financial planning industry. And then if they can have that experience with someone and start to see what it looks like, they may say, that's different than I thought, or that's very much lines up with what I was thinking, and that's exciting. Or someone may say, not for me. Right. And I'd rather that they did that thinking.
And we've had some of those
as a high schooler.
Amen. Yeah, no, that's all good.
Yeah, and speaking of money,
how we handle the cost of college. Cost of college is crazy. So
no one has a magic wand, right? And at the same time, I know you've got two getting ready to go in. We've got one out and one getting ready to come out. The numbers are just
crazy.
They almost make you choke. They're so large and getting larger,
right?
And
I think what I shared with you on this, we've told our girls, We'll cover 3 years.
Yeah.
That's it. So we want a little skin in the game. So whether they have to work
that's awesome.
or get a loan or whatever.
Awesome.
So parents think that's part of our discovery when we go through this. Okay, what is that amount? Is it 2 years, 3 years, all 4 years? So it's a personal choice. Everyone's going to be different. But like we've already had that conversation with our daughter, so they know. And I think you have sort of had that.
We did,
too, so.
and I think that goes right into one of my key tips that I would share, which is setting that budget and sticking to it. Right. This is where so many families go off the rails. It is unbelievable how emotional, and it's not unbelievable. We're parents and we want the best for our kiddos, and yet emotion gets tied into this college thing, and we go on a college tour accidentally. For a college that costs $80,000 a year. And our kiddo's like, oh, okay. You're like, no.
No.
Like, that is not
in-state, please.
That's not going to work out. Well, that's where that budget, like setting and kind of having those conversations up front helps your child and your whole family know these are the boundaries and the barriers financially that are going to make sense to pay for these 4 years of college. And on some level, you know and I know that those 4 years of college are essentially a commodity. And so what do we do for commodities? We generally try to pay as little as we can, right? So when I go for my gallon of milk, I want to pay as little as I can. Given all that, making sure we have those boundaries, we've talked about that with our kiddos. They know what those numbers look like. Because in the end, when you apply to colleges, let's say you apply to 10, you get into 5, you will eventually find out what each of them costs for all 4 years to go to that college. And I love the power of saying, we have this budget, and if that college brings in their number and it fits, great. They continue in the conversation. If they don't, they have what I like to say, they've eliminated themselves from contention.
That's great.
Bye-bye. Yeah.
Bye-bye.
So, and I'm not being mean, but ultimately you have to get down to one college that you'll go to. And in the end, a lot of times it comes down to money. So, totally and most families, Erica, they really want to, I hear it, I'm sure you do. They want to pay less for college. They just want to pay less.
2-year degrees, career tech schools. I'm all for that. Andy and I and our crew here.
100%.
You don't have to necessarily have a 4-year degree, folks. So just remember that, especially in today's.
Well, and I think what is a wise approach is for a family to think at the end, as my child is moving through high school and having these experiences and having academic experiences, and they start to think about what kinds of careers can be a great fit for me, then the next natural step is what education do I need to do the kinds of careers that I'm thinking about? Is the education that I need really, am I going to best enter that field with credentials and certifications? Do I need a graduate degree if I want to do that thing? Or do I really need a traditional BS or BA? Your education should be tied to the kind of work that you're thinking about doing. So I think that's really important to bring up. But and on the paying less for college, I just want to give a shout out to merit scholarships and dual enrollment real quick. So everybody, talks about wanting to pay less. And certainly if your child chooses a career that is tied to a traditional 4-year institution, let's say they need that bachelor's, how do we pay less for it? Well, the biggest way to discount that college cost is through merit scholarships. So that's the money that a college will offer a student because there's something about that student that the college wants to do to attract that student to their student body. So they're going to discount the cost to that student in the form of what's called merit scholarships. So back to Academics Matter, merit scholarships are all, they're typically tied to GPA and ACT and SAT score. So if you want to see, that opportunity for your college to offer a discount, then you have to be a student that is attractive to that college. And not all colleges offer merit scholarships, but that's where the biggest discount will come. Second, dual enrollment. I am stunned and amazed at some of the students that we've seen that are leveraging dual enrollment programs across the U.S. So these vary state by state. We're in the state of Ohio. State of Ohio has an unbelievable dual enrollment program called College Credit Plus.
Yeah.
That program is very strong in that it allows a student, while they're in 7th through 12th grade, anytime in there that they qualify for participation, they can take real live college classes, earn college credit, earn simultaneous high school credit, and out of your pocket comes $0 as long as they pass the class. Right. So a kiddo can earn, and many kiddos in the state of Ohio and across the U.S. are earning a lot of college credit while in high school. Beautiful. And then their college search becomes which colleges will take all these credits that I just earned. If I earned 38 credits and my family didn't pay anything for it, it would kind of be silly to choose a college that didn't take all those credits. So there's 2,000 four-year colleges that are out there. So pick one that will take all those credits that you earn.
And lower the cost.
But that in itself, people don't think of it like a scholarship. Yeah. But I like to think about it as a way to truly reduce your cost of college. And then I guess the last thing I'll mention, and I know you're gonna share that as well, but the last thing I'll mention is just the idea that your kiddos got to have, in terms of saving money on college, it works out best if they have a reason why they're going to college. So if you head them off in a boat toward college and they don't have a sense of what they want to study, what they want to accomplish when they're done, what that looks like at the end, then it's almost like putting them in a boat that doesn't have a rudder. And so they're gonna wander around, and they may spend
a year or two blowing it through the college. Junior year, hey mom and dad.
The winds may come and blow the boat over here, and we're thinking, oh no, your 4-year degree should be done in 4 years, right? And so I just am we're big believers in making sure that kiddo has a reason why they're heading to college, and we do a lot of work with students in that regard.
And to that, only I think 41% roughly of undergraduates graduate in 4 years.
Is that, I mean, you need to say that again, because if that's a new stat to people, it is mind-blowing. One more time.
Only 41% of undergraduates finish in 4 years.
Finish a 4-year degree in 4 years.
Right.
Stunning.
Right? So that means the vast majority do not.
That is right.
60% plus.
Yeah, and I think the other number was something like 63% will finish within 6 years, which is worse. So then there's what about all those other ones? Well, they've gone to college and they come away with debt and have no degree. Right. So I know you're going to hold something up. I can describe it if you would like.
Briefly, it's like a matrix. So I came across this. We utilize Beth and her team's services. So it's just, and our Nathan, our producer, will put this up too. But, middle school, then there's high school, just a target to help focus you in on certain things. And her group, her organization helps you navigate that, career coach, do self-assessments, testing.
Yep.
Lots free, some very nominal charges. So I'll let you then.
So no, that's good. So all those things on the left-hand side are various programs and webinars that we do. And we just tried to make this chart so that if you have an 8th grader, you knew which things should I pay attention to. If I have an 11th grader, which things should I pay attention to?
Keeps you organized because the school year is a blur.
Yep. So. And I would just urge families to, get involved with those trusted partners like yourself, like CAP, like us, that will help guide you toward making those decisions with more confidence and clarity. It is tricky stuff.
Oh, it is.
It's hard. And then those emotions get in the way.
And everything's changing too.
And the cost is like, so we're here to help, and we're very grateful to be a partner. Thank you.
Thank you for helping us and our clients. And
shake my hand. Absolutely.
Right.
Thank you.
There you go. There's Beth. Great. Hey, welcome back. Hope you enjoyed that little segment with Beth. She's fabulous. I just wanted to reiterate, and on our website here, when we push this out, you will see a tab there located just for educational purposes for middle school, high school, and also college planning as well. So just career planning, college planning, skills, things you can utilize for your kiddos now. And we're going to have their websites listed at the core, and also with College Aid Pro. So we've partnered with them. So you can tap into that. Please reach out to us, any of your advisors. We have a free code that you can tap into, gain access to all the college courses, meaning curriculum, cost of colleges, what it looks like. And we've made that available to you, our clients. So again, reach out to any of us, and we'll provide that code for you so that you can log in and you don't have to pay the subscription because we already have the agreement and arrangement on your behalf. So we're just trying to make this a holistic one-stop shop for you when it comes to your schooling, college, career needs, etc. So with that, let's talk on tips of the month. So just a few little point. A couple months back, I want to bring this up again. Fifth Third Bank, with the commercial lending, they basically announced that they're pulling out of all the commercial real estate loans, and that was just a couple months back. But the commercial real estate sector, the foot has not yet fallen. So expect more announcements when hearing about the commercial side of things. So I wanted to just point that out. Number two, basically, with the car prices. So there's now one manufacturer, it's Mitsubishi, who has one car that is under 20,000. So 8-10 years ago, there were over a dozen makes or models that were out there. Now it's one. So they're going to cease that production in 2024. So then there'll be zero. So the upshot's this. No more cars basically under 20,000 going forward after 2024. Right now, it's Mitsubishi is the last one out there. And the average car price is right around 48,000 approximately. It has come off the high point of over 49, come back down somewhat. And people are basically paying roughly $725 a month in car payments. So that's crazy. So keep this also point in mind with the student loan debts. So that's going to start back up here at the end of October, going into September. So again, it's going to affect more of the folks who carry student loans or the middle income earners. So already the low income earners are hitting it, suffering. The middle income is going to get another portion of their assets will be taken away. $400 or $500 a month will be earmarked for their loan repayments. So that's going to dry up. Those sources of funds that could go to spending or keeping up the economy, et cetera. So that will be a drag on GDP. So that's all going to be factored in. So just keep that in mind as that, the party's coming to an end, basically all the free money, over stimulus, the M2 money supply. We've been talking about that for a year and a half, 2 years now. So we're starting to face reality. So things will get a little bit more choppier and harder when it comes to that. So with that, I just wanted to point those few things out. I hit a couple charts for you here, moving into our favorite piece because I'm visual, but with charts, the stock PE ratio for the S&P 500. So the average typically has been 15.6 times forward PE, price to earnings ratio. Right now it's 19.1. So it has come down. It was almost 20. So now it's down to 19.1. That's because we had the market pullback here the past couple of weeks. The VIX, Volatility Index, you heard me talk about that. Remember, it was 13, 14 range. It did spike up to 17.1, a little over, closer to 18. But that's where it is as of yesterday, August 21st, 17.1. Again, it's just what the traders think, the options traders, 30 days going out. This is becoming less and less important because of the 0 days to expiration for those daily options. So why go 30 days out when you can go day to day out? And that's really moving the markets. Basically half the trading volume that occurred in the S&P. Pullbacks of 5%, still at 1. Again, the average is 4.6 times per year. You have the S&P pull in at least 5%, and that's only happened one time officially. Currently, about the most recent was this past week. It came in about 4.8%. That's why it didn't register because it didn't officially hit 5%. Trailing 12-month earnings per share and the GDP, it's still going down, but I do see a little curve up. So it is, again, it's minus 1.1%, but hopefully that will, bottom out. Again, the historical average is 7.8% for the earnings growth rate. So just things are growing, but growing at a slower pace per se. Interest rate to 2-year, 10-year, again, this is big. Basically, the average 10-year, going back to 2010, is about 2.38%. Right now, it's on the 10-year, it's 4.34% is the average 10-year yield. So you can see it really spike up there, hockey stick up. And then the 2-year, again, that average is 1.17%, going back to 2010. And right now, the 2-year is 4.97. So when we talk about the inversion, all that means you're getting more yield on the short end of the yield curve rather than the long end. So why would anybody really want to own long end per se yields at this time? So meaning, 10, 15, 20, 30 years going out. There will be a point to go to that 10-year, and we're getting closer and closer as well. for that. But the 3 month, 6 month, 12 month, 2 year is what we have for my clients in particularly. So I wanted to point that out. The yield curve steepness, this is the inversion. You can see it's minus 0.63. It's been over 1%. But it's funny, they talk about, low unemployment, 3.5%, and then the inversion of the yield curve when it was like 1% or more, now it's coming back, closing that gap. That's sort of like the beginning of the recession, is what a lot of indicators. So now let's talk about that recession briefly. It's been pushed back from the third quarter to the fourth quarter from one of these economic observers. So fourth quarter, whether it happens, officially or not per se, the point is it's going to be shallow, and the duration won't be that long as well. So we don't see a deep recession, just a shallow and a short-term recession. Mortgage rates. So the mortgage rates actually almost 7.5%. So I think 7.48 is the what I saw hit the print today. 7.48, almost 7.5. That is the highest mortgage rate for a 30-year going back to the year 2000. So that's 23 years. This is the highest rate in 23 years for mortgages. So, again, you can see the averages there going back to 1990, 6%, and the average since 2008 is 4.2. And this is dated August 17th at 7.1, but I saw a print at 7.48%, almost 7.5, which is the highest in 23 years. Leading economic indicators, again, still the leading, they're negative. So every leading economic indicator, when it's negative, leads to a recession. That's why we call this a rolling recession. Parts of the economy are still in recession, other parts are coming out, and it's been ebb and flow and changing thereafter. So again, we're still invested, making tweaks. We'll make other tweaks to get more aggressive, but just not right now. We anticipate more market volatility, and minutia, we'll just change things up and stay on top of everything as best we can. So again, we appreciate you, our relationships from all the advisors, Andy, Eric, Jim, Russ. I think we hit everybody, myself, Stacy, and the crew, even Nathan, our producer. We appreciate you listening in on this episode. Reach out to us if you want to get a more detailed information in person, over the phone, web review. We appreciate you, and we'll see you next time. Enjoy.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal.